To this week's edition of Selfwealth Live Technical Analysis edition that we're running here. Jason, hello, and how are you today?
Hey Rog, I'm good. I'm looking forward to talking about some charts and some ideas and taking some questions. Always a lot of fun doing that.
Exactly. Look, I appreciate you being here once again. I appreciate the viewers coming along. We I can see during our live show now, we are actually getting an increase in viewers, which is fantastic to see. Obviously we sort of started this last year with the hope that we would, provide some different type of analysis to your standard old, fundamental analysis. So I think we're on the right track here, Jason. It's been great having you on the show. Today we're obviously going to go through our regular market analysis. Our educational piece will be around, a lot of people, whether they're buying on breaks or whether they're waiting for it to pull back and buy on a dip. And then we'll go through through stocks of viewer analysis. So, Jace, before we go through all that, did you want to talk about your disclaimer, please?
Yeah, quick disclaimer for everyone. So everything today is general commentary only, doesn't take anyone's personal situation into account, and just putting our disclaimer up. So the other point to make is I'm not part of Selfwealth. I'm motion trader. That's my business. So I've got a disclaimer at the top, has my licensing details, etc., and there's the Selfwealth disclaimer below that. And again, all pointing out it's general commentary only.
Yeah, thank you very much for that, Jason. And once again, don't forget to like and subscribe on the videos, or comment and share as well, right? Because that's how we can increase these viewers, number of people we can hopefully affect and impact and educate, right? And also keep it going, right? So it'd be much appreciated when you do that. All right, so let's get on to the markets this week, Jason. What's the Aussie market doing for us?
Right, well, let's jump over to our charts and start with the ASX 200. And look, I think the investor focus really seems to be about buying dips. And that's been the case really all of this year. And we've seen it again over the last couple of weeks as we've got this had the dip, and then we've had the rebound again. So one of the technical indicators we've been watching is this 50-day moving average. So I've got the 50 and the 100-day moving averages. They're the two averages I typically use. And it's been a case of every time the market comes back to this 50-day average, we get some sort of a rebound to the upside. So the ASX 200 really does seem to be finding support, and that buying interest, which has been underpinning the market around the 50-day average. I think people have been generally underweight stocks. When you look back at how things were back in October last year, there was a lot of negativity around, a lot of reasons people could find not to be in the stock market, or be just watching from the sidelines. And we've had this quick rally, and I think it's probably caught a lot of people being underweight stocks. And look, that's easy to understand when you think about that negativity that we've had. And I think what we've been seeing is this classic rotation back into the stocks, and we're getting that classic buy the dip action now. Each time we get those pullbacks, people are seeing it as an opportunity to get back in it at a better price than if they're just coming in at the highs. So I'm bullish. I'm long the market. That's been the case for a while now. But look, having said that, I never want to be blindly bullish. So yeah, I got a positive outlook, but it's not just, look, this market's going up, it's going up. It's not blindly bullish. I'm always looking for risk and then trying to manage that risk. So I'll show you one of the things I'm keeping an eye on with the ASX 200. So I'm just going to get a relative strength indicator, an RSI, and like the thing which stands out to anyone who knows their way around RSIs and price action, they'll see we've got a series of rising highs on the ASX 200, but you come down to the RSI, and we've got a series of declining highs. So we're not getting that confirmation of the upward trend. which is something which I think is worth at least being aware of. I don't think it's pointing to a major top, anything like that. Rather, I think it's more a case of there's potentially pointing towards maybe just a pause in the trend, because this has been a big rally, 16% or so in 4 or 5 months. It hasn't really been much of a pause. Maybe this divergence tells us the market's getting tired and needs a bit of just some sort of consolidation. Now, look, I think an important point to make on this is that divergence doesn't always play out. It's just a fact that I take on board the other things. So I'm certainly not getting out of the market. I've out of the last few weeks. I'm just being selective about what stocks that have run hard. I've got a few stocks in my portfolio that have run hard, and I'm happy to keep them, but I just don't want to chase new stocks that have run hard. And we often talk about, Rog, those wide trailing stops, and I'm using those on my positions. So I'm kind of hedging my bets, I think you could say. So it's a case of that if the market does continue to run here, well, then I'm long and I'm in the market. That's all good. If it does consolidate and chop around for a bit, well, I've got those wide trailing stops which track fair way below the market. So hopefully I can then ride out any consolidation. But if I've got this all wrong and the market is topping out here and does go into a larger decline, well, then I've got an exit point. I'm not anticipating that, but you don't anticipate everything. What you think's going to happen doesn't always play out. So it's look, I think it comes down to nobody knows what will happen. So I think it's important that we have a plan for everything, and that's the scenarios I was just playing out, building out then. And if you don't have a plan for everything, well, look, hopefully that's what these videos are helping with. That's what we're doing. We're talking about strategies. We're talking about knowing what to do if your stock's rising, if it's going sideways, if it's falling. At this stage, just summing it all up with the ASX 200, I think the overall trend's upwards. I want to maintain exposure to the market, but I just don't think this is a moment to go out and buy anything and everything. Be selective, manage risk. And I think if you do those two things, selectivity and managing risk, I think that's what keeps you in the game long term.
Yeah, it's been a very similar narrative over the last month or so, where we're just straddling on the all-time highs at the moment. Could be a double top forming, might not be, might just break out again. So we don't know, but what about the US market? What's that look like?
Yeah, so just going over to the S&P 500, and look, and as you said, it's a case that it always is a case that no one knows. We're playing with possibilities and probabilities, and we're managing risk. So it's not a game of certainty. We're always operating in an uncertain environment, and that's why we need these strategies. It allows us to adapt to what's happening. It's not about predicting what will happen. It's about saying, well, look, if the market moves upwards, this is what I'm going to do. If it pulls back, this is what I'm going to do. Having those plans for a plan for every season, so to speak. So looking at the S&P 500, and another period of brief consolidation, just a couple of weeks, and then off to another all-time high. And this is this brief consolidation we had over the 2 prior weeks. It's the fourth consolidation that's lasted about 2 weeks since the October low. So you come back to the October low and you go through, and we had there's our first period, second period, third period, fourth period. So these brief consolidations of a couple of weeks, and then following through to new highs. And each of them had the potential to come back and retest this 50-day moving average. But the persistence and the strength of the trend has continued, and we haven't had any of those typical pullbacks to the 50-day moving average, which we often see. So lots of speculation at the moment about when a correction will occur, and we know it will occur, we just don't know when. And I've thought that a retest of the 50-day moving average has been due for a while. I've been talking about it probably since January, that I thought, would come back and test that moving average. But, the market has kept running. And this is why I think it's so important to use trailing stops and not try and preempt tops, because often the market runs longer and further than you expect. And so, you make that money by staying on trends, not jumping off early. I think and I think that's the most appropriate strategy at this point, and it has been for a while. It's letting those profits run. And yes, prices have come a long way, but there's nothing to say they can't go further. I think the key here is just being able to manage risk. And for me, as I said with the ASX 200, it's about, I think it involves those wide trailing stops. I want to keep this upside open because we just don't know how far it will run, but also having those exit points for when a pullback develops. If it develops into something larger, we want to have those exit points in place. If it's a pause and just come back to the 50-day average, well, then if you've got the right sort of exit strategy, you can see that off and potentially stay in for a larger advance. But at the moment, trends up, staying in.
Yeah, very good. I think one of those things is that I keep on going back to when you mentioned about having a plan, right? And as a beginner, it's one of those things that's vital. I don't know about you, Jason, but I know I have my trading plan still written out on computer, like on a page. Basically, I try to keep things to one page to keep it simple, and then have it with me whenever I'm putting a trade on or anything like that. Do you still do that, or?
It's written down in a sense within a program. So I've got my systemized program. So I download the data each day. I run it through the algorithms, and I get what to do the next day, how much to adjust the stops. So it's all. So yes, it is written down, but I guess it's written down in program. And but having said that, I think everyone should be able to write down the key points of their trading process on back of an envelope or a back of a coaster. It as you say, you've got yours is on a page, and I'm sure you could summarize it in like on the back of an envelope. And it should be that simple. If it's so complicated that you need a chapter or a book to explain what you're doing, to at least summarize the key essence of what you're doing, it's probably too complicated. And complicated processes have a tendency to be that they tend not to endure over time. So keeping it simple, what's your entry process, what's your exit process, what do you do if a stock's going up, what do you do if it's going down, how you're spreading your risk, how you're deciding how much to invest in each stock. All these questions we need to answer, but it can be quite simple. So I think writing it all down is a really good thing, because it really does help crystallize in your mind what you're doing. And when the markets get a bit volatile and emotions start to come to the fore, you look at your plan and go, okay, what does the plan say? What should I be doing here? Rather than guessing and clutching at ideas, you just go, okay, what's the plan? Follow the plan, stick to the plan. Because that's what we do. We come up with our plan when times are quiet and there's no stress, and then our plan's there to execute when things get pretty unnerving, and that helps us stay in the game, helps us stay the course.
Well, look, I have to thank you, because at the end of the day, I probably started a similar. Like, obviously, I read all your material about a year ago now. I don't follow your rules to a T, but I have my version of it based on what we're going to be talking about in very soon, in the next few minutes, based on like when I buy. But I'm beating the market, the general market, as a benchmark, whatever it is 10% a year. That's been forever and ever and ever. Over this 1 year test period that I've been doing this sort of trend trading system based on stock on the ASX market. They only trade the ASX market, right? So I'm beating it quite convincingly at the end of the day. So obviously that's not going to relate to everyone. Might not relate to that, and please don't, don't hold me to account, but I know for a fact that it works. It's working now, right? Well, maybe we're running on a bullish run. I don't know. Maybe we need to be very careful, as you say, of that downside. But I'm prepared with a plan now, based on some of the stuff that you've already taught me, and what I'm really trying to hold myself to account. So I hope other people can learn these sort of concepts as well, right?
Yeah, like look, and my precise rules aren't the holy grail by any stretch. It's about having a repeatable process, and there can be it's like you can vary, take what I do and make your own variations, and it's still a repeatable process, and that's great, and it's just personalized for what you're trying to achieve. And a lot of people don't have a repeatable process. They go from one trade to the next, and they're all a bit different. They're buying because they read something or they heard something, or they something popped up on Twitter and they go, that's an idea, I'll have a look at that. And then they sell when they get a scary sell-off, and they go, oh, I'll sell now, or I'm up 15%, I'll sell now. There's nothing repeatable about that. And someone will get out of a stock. So let's just hypothetically say someone makes 30% in a stock. They get out, and you go, okay, explain why you bought, why you held, why you sold. And often you won't get a very coherent answer. It'll be a lot of umming and ahhing and, oh, I felt this, and a bit gut feel. Nothing repeatable there. But what you're doing, Roger, is repeatable because it's all written down, and you follow it. And sometimes we stray from our rules a bit, but the people who do best tend to come back, and they're pretty good at following those rules. And they're the ones who stick around for a long time, as opposed to the ones who, it's all punting and they blow up their accounts. And we all hear about statistics about trading in markets that doesn't work out for most people, because most people, I think you find, don't have a plan. And it's so important. You hear all the great traders, everyone who's been in the markets for a long time, they tell you the same thing. Have a plan, be consistent, make it repeatable.
Yeah.
And you don't outperform all the time. We're going to have periods which are really difficult, and we won't outperform. But it's about being consistent, coming back month in, month out, year in, year out, and that's where we can get the outperformance. And if you can outperform the ASX 200, I think you're doing extremely well, because it's most people can't outperform an average. We just do the maths on it. It doesn't work. You've got to have those who are below, those who are above. So coming out above consistently is, I think, it's outstanding.
Yeah, exactly. Having a plan and treating it like a business for me has always been important as well. Having habits that I mean, obviously it's not a big. I haven't got a big corporate business. My pain point is I don't have enough capital to trade all these amazing opportunities that we have here. But what I have is working right now. So, all right, we've gone a bit off track because a bit of psychology, bit of concept work here. What about the Hong Kong? I know we picked this turnaround a few months ago, so some of this technical analysis actually works. Let's have, what does that look like?
There's definitely something to it. It's look, just have a quick look at this. Not a lot to talk about this over the last week. Broke to a 3.5 month high a couple of weeks back, and now we're consolidating, coming back towards 100-day moving average. Again, the 50 and the 100-day moving averages on the screen. I think what happens at this current level is going to be pretty important. We do have some early signs there could be some sort of a turnaround going on. We've got that series of higher lows and higher highs. That's always encouraging when you see that. And these moving averages are slowly starting to turn upwards. So that's positive. They haven't crossed yet, but they're moving in the right direction. I think to keep the near-term progress on track, I'd like to see this supported around 16,300. I'd like to see that stay intact, see if the market consolidate and hold above that, and then maybe from there have another push higher. And it's a similar situation when we look at what's going on in the Chinese market, although the price action is probably a little bit more developed than we're seeing in Hong Kong, in that the moving averages have already crossed. Prices is also more above the averages than we're seeing in Hong Kong. The same series of higher lows and higher highs, and we're seeing this another little tight compression band going on. Just seeing there where the prices has rallied nicely, now just compressing sideways. Maybe, and these are good. I love when we see these patterns. It's often a sign of accumulation. Now, maybe this extends further while the moving averages catch up, or maybe it has another push higher. It's an interesting one to watch and keep an eye on. I think there currently is a play to the upside in these markets, and see where it goes. It's certainly, we wouldn't be calling this an uptrend at this point, but look, there are some tentative signs that maybe something could evolve from this.
Yeah, very good. All right. And just for the viewers out there, obviously, we're looking at the Chinese market just to see the correlation between the Chinese and the Hong Kong market. Generally, one sort of starts tracking the other. We don't offer the Chinese market on the Selfwealth platform, but we do offer Hong Kong, right? So we do offer stocks on the Hong Kong. I don't know, is there a Chinese? There'd be an ETF that tracks the Chinese index, I'm sure.
I'm sure there would be. And the reason I bring the Chinese market in, because I think that more and more that's a key influence over the Hang Seng. The Hang Seng, I think, used to once be fairly independent to the Chinese market, but as the political landscape over there has changed, it's now the Chinese market really is I think the dominant influence. So it's like when we look at the ASX 200, we also look at the S&P 500. I think we've got that same coupling going on with Hang Seng in China.
China 50, yeah. All right, let's go to a couple of questions before we move on. Would you still use these wide stops on, say, the top 100 stocks? They do not have the same potential for 10 baggers, 10 times the value. I'm assuming they bought it.
Well, it's what I'm using. It's an ATR trailing stop, so an average true range that stands for, which is essentially it's taking the average trading range over a period of time, maybe over the last 2 or 3 weeks, and putting a multiple on it. So if you get the average trading range and you put a multiple of 2, so 2 times the average trading range, it's going to be pretty close. Whether it be a volatile stock or CBA, you give it a wider multiple, like I use a multiple of 10, and so that keeps it a fair way away. It can be a long way away if it's a volatile stock. But the beauty of the ATR is it's going to adapt to the situation. So a stock with less movement, like a top 50 stock, it's still adapting to which situation. It's still 10 times the average trading range for that stock. So yes, I think they're just as effective. Like you call up a chart of CBA or BHP or Cochlear. They've got pullbacks of 10, 15, 20% as well. So if you're going to set a 5% or a 10% trailing stop, you've still got a problem with staying on them. So this is why I think the ATR is a really good way to do it, because it does adjust to the situation that you're looking at. Big stock, small stock, I think wide trailing stop is the way to go if you want to be in a stock over the medium term, like 1-2 year potential. If you want to be in for the next 2 weeks, well, then you're looking at something else. But if you want that medium term upward trend potential, I don't think there's a substitute for that wide trailing stop in terms of staying in, managing risk, having an exit point, letting profits run. It covers all those bases.
Yeah, very good. What about do interest rates affect the market?
Yes, but in different ways at different times. Like sometimes you'll find stocks rise in a rising interest rate environment, because you think about, look, why are interest rates rising? Often interest rates rise because the economy is strong and has been strong, and so interest rates start to rise to try and cool the economy down. So that can be within a large upward trend, and you pull up overlay charts. You get the stock market and you get an interest rate chart, and you'll see there are long periods where rates are rising and stocks are rising too. So it's not just, rates have gone up, stocks have to fall. It doesn't quite work like that. You've got to look at the situation of why that may be. We had what was it, during 22 when interest rates started going up? It was all inflation was a concern. So that was, that negatively impacted stocks on that occasion. But yeah, it's not. There's not a single rule that they move in lockstep.
Yeah, and as you pointed out, interest rates are rising now, and so is the stock market, right? So plenty of money to go into those risk-on assets, basically. So going around, there's obviously, it's great that people are writing code in Python to check out for the gaps. That's really good. I hope that helps. Do you have any rules around gaps at all, Jason? Gaps in the market? Or?
Not specific rules. Just a gap up on high volume is often a good thing. So people see a gap on high volume. Now, if it's a takeover situation, maybe that's a bit different. But say they come out with an earnings result and it's a high volume gap up, it will often, a lot of people will look at that and go, oh, well, I've missed it. I'll forget about that stock. But it's often a good buying opportunity, because that initial gap is the initial re-rating, and then it will continue to be re-rated in the weeks and months ahead. So yeah, not being scared to consider stocks that are gapped higher if it's a strong volume move and you understand why it's happened. It could be the start of a larger move. So, but I don't have a particular trading rule around it.
Fantastic. And then just finally here, we do not connect to TradingView, even though we use TradingView. The Selfwealth platform doesn't directly connect to TradingView, so you won't be able to sort of get the data that we get on Selfwealth on the TradingView platform. Obviously, we have the market depth on the Selfwealth platform, but if you're looking at the market depth on TradingView, that has their own data. They have their own data, which is generally 20 minutes delayed, because unless you have a paid package as well on TradingView, which they can have live data on TradingView, I know. All right, let's get on to our topic for the day, and I'll get on to tickers at the end. We'll have a look at some tickers at the end of this, obviously. But let's just quickly talk about what is buying on the breakout. What does that normally entail, Jason?
Well, all sorts of ways to buy. There's buying on the break, buying a stock when it's on support, buying a stock that's dipping, buying a stock that's pushing and extending higher, buying for fundamental reasons. Someone will buy because they calculate a stock as below its intrinsic value. So there's all sorts of ways we can buy a stock. Buying on a breakout typically refers to a situation where you have a stock trading in a range of some description, and then you get a push to the upside of that range. So it goes from trading between say for example $1 and $1.20. It stays within a 20-cent range for maybe a month, and then trades up to $1.25. Then we have a breakout. And trading breakouts is really interesting. It's a big part of what I like doing. And I think maybe we'll have a look at an example. Let me just call a chart up, and let me just get back to where I need to be. Let's have a look at ANZ, because that's a big stock with a really nice breakout a couple of months ago. So breakout there's a couple of types. This is a good example because we've got two types of breakout going on. So first of all, we've got the resistance. You can see these previous highs. They all sort of line up at around $26. And so we had a case every time ANZ got up there, supply came in, price started to pull back, until ultimately, and this was in mid-January, price broke above those previous highs. So that's a breakout. That's a buying opportunity. And then another type of breakout we also have, you can just look in this point here, we have a tight consolidation going on where the price got up to that resistance point, then just started to contract or started to compress into a tight range, and then broke from that, as well as breaking above that overhead resistance at the same time. And what I like about these breakouts is that they really offer an asymmetric risk reward setup. So what I mean by that is that the upside potential is typically pretty open, but you can manage your risk to the downside. So what I'd like to do with the breakout is that I might set a stop loss. So if I was playing this break, I see the breakout, I can take a position and I can put an exit point just back, maybe even as close as just back within the middle of the range. And so you measure that out and say what's that? So it might be, in this situation, there might have been like 2, 3, 4% of risk. And you go, well, look, what's the upside potential? And you look at the chart and you say, well, look, maybe you could get up towards these previous highs, which is around 11.5%. So if you're taking 3% risk and potential upside of at least 11%, well, you've got a 3-to-1 ratio. And measuring your upside is really just, you can't, we don't know where a stock is going to go. It's just saying, well, look, it's relatively small risk to what could happen. And so far that's played out. It's up about 11%. So that could have been done on fairly low risk. So that's a breakout, and that's how they can be played. I'll show you another example. So this is a breakout which I actually did get involved with. It's a stock called TUAS, TUAS, ticker code TUA. Can't pronounce it properly. TUAS, I think it is. It's a telco. It's a telco, and so let me just track down the chart. So this is a motion trader stock. It's a stock in my portfolio. So I bought on the 4th of May. So it's this day here. So here we go. So we've gone from below the moving averages. You see, we've had this period below the moving averages, not looking at it at that point. Rises above the moving averages cross. So these are all starting to line up. And then we get this sideways period. You just see this sideways compression back towards the moving averages. So this is a type of setup which I really like. When I see a stock go from below the averages to above, then trade sideways back to the averages, form a range, and then break to the top side. So that was a buy point for me. So I only actually bought half a position. And you think, well, why? You might ask, why do I only buy half a position? Well, if you think about what was going on in the All Ordinaries or the ASX 200 back in May last year, it was a pretty unpleasant sort of time, a lot of uncertainty. And I was being cautious, and I bought half a position. And what happened then? We got a bit of a run, and we got another consolidation. And again, this is a bit of a sideways consolidation again back into the moving averages. And so I saw that, and then I saw another breakout. And so what I did, I traded the breakout again, and I bought the other half of my position shortly, or just as we got that breakout from this second range. And so, and looking at the structure of this as well, we spoke about structure last week. It's like we've got a stock that's moving upwards above these rising moving averages. So a very different situation than what we'd seen in during 2022, early 23, when it was traveling below the averages. So the structure has become opportunistic in that this is where some of the best ideas form, and we had pauses with breakouts, providing the entry opportunities. And this is also a great example of why we follow the price action, not the headlines. So again, thinking back, what was going on in the markets in May and June last year, and it was heaps of uncertainty. And you look at what this stock has done, up 130% thereabouts from the average of these two entry points. So that was buying breakouts, using breakouts as entry points, and not getting fixated on the news flow, headlines on the papers, on the nightly news, all of that. Cost of living crisis, inflation's out of control, everything sounds really bad. But bring it back to the price action, bring it back to the market structure. We have a company which is trading above rising moving averages, breaking to the top side. So we can manage risk around those, can manage risk, you can have the exit point relatively close, but you keep your upside open, and good things can happen. So I like buying these breakouts. Those price compressions, when a price compresses into these narrow bands, it often acts like a spring, and this is why I like trading these breakouts. And so then when you get the break to the top side, you can see that what it's telling us is that there's an imbalance in the marketplace, and we've gone from a period where prices have been in balance, the buyers and sellers have been matching out, to a place where the buyers are now forcing the issue. They're more aggressive in getting that stock on board, and that's causing the price to move up. So that's what we're getting on board, and this is where you get those asymmetric setups that I've been speaking about. And breakouts don't just happen in stocks; they happen in you can look at the indices, you can look at commodities. So just looking at gold, for instance, this is a classic breakout. I'll just let me actually just pop this on a weekly chart, and you can see in gold. So this is 3.5 years in the making of all these previous high points, and we now have a breakout. Here's another example from back in the late, back around 2017, 2019. We had previous highs lining up, and we had a breakout. The breakout led to a really nice move. Whether the same happens now, well, time will tell, but that potential's there. It's asymmetric in that risk can be just managed just below the breakout. If it runs similar to what it did previously, well, it could lead to some really good gains. I'll show you another example. Now, this is a great one. Now, if you've been watching the news, or if you watch my strategy session video on the weekend, you'll know where this one goes. But for those who didn't, it's really interesting. This is cocoa futures. So the ingredient behind chocolate. So it hadn't done anything for years. Big sideways range. Nothing exciting going on at all. And but big ranges often lead to big moves. Not always, but often. So here we go. So cocoa moves along, and we get a breakout from the range and rallies a bit more. And so this is an interesting game for viewers who don't know the answer of this to consider. It's like, imagine you're bought on the breakout of this range. What do you do? So, and this is where a lot of people really make a mess of, with taking early profits and small profits. So we get a bit of a run, and what do you do? Do you stay on this trend, or do you take your profits? So I think the majority of people, are taking their profits. They're going, look, this is great. Cocoa's done nothing forever. This surely can't last. I'll take my profits. But then it runs a bit. We get a pullback. So now people start thinking, oh, well, maybe I'm going to give back all my gains, so I better sell and get a bit more volatility. And people get quite nervous and definitely thinking, well, look, I've got a good profit. I'm out. This is why I use those wide trailing stops, because you can see these pullbacks off, and then cocoa runs again, get another pullback, more profit taking going on, because surely this can't continue. But it does. We keep seeing this rally unfold, and off it goes. There's last night's high. It's interesting. Last night's trading range is actually more than the width of it's more than the width of this trading range. So in one night, it has done this whole trading range. It's extraordinary, isn't it? But that's you don't expect this from every breakout, but that's why we let profits run. Because when you do get a breakout, you get a nice asymmetric entry point, and you just never know. Some of them do some extraordinary things. Just to balance it all though, Rog, I want to show you one more thing on breakouts.
I think that's quite ironic, considering we're coming into Easter.
The Easter run. There you go. Yes.
The Easter bunnies has bought up all the cocoa, and it's driving prices up.
Yeah, look, just to balance it all. So everything I've said so far has been very positive towards breakouts, but they don't always play out. They don't always work. It's not, there's, they say, there's no free lunch. There's no free lunch with the breakouts because sometimes they fail. And here's an example from a couple of years ago. It was the Russell 2000, the US small caps. This had been a range which a lot of people have been watching, myself included. We got this breakout, got a breakout it was November 2021. And this is bullish. I was bullish. People following this range, people bullish on this. We have a breakout above rising moving averages. What was it? It was a 9-month range. All looks good. We get a bit of a pullback, a return move. That's okay, no problem with that. But then the pullback starts getting bigger, comes back within the range, falls below the moving averages. So at this point, it's a false break. The break just hasn't worked, and that's okay because we've got a risk management strategy behind that. As I was saying earlier, you can buy a breakout and then just set your exit point just back within the range, maybe below the moving averages. So you're out. It's a relatively small loss, and losses are part of the game. They're part of the process. You're going to get losses. That's okay. So this one didn't work out. That's not a problem. So it's like buy the break, see where it goes. Nope, this one's not cocoa. Down it comes, exit, and see what it does. Fell back towards the bottom of the range. Now it breaks below the range, and the moving averages turn to the downside, and it's a clear sign that there's trouble ahead. And this is in January 2022. So anyone who knows their history from 22 knows what happens next. So the price action really gave us clear warning that the underpinnings of this market were not good. It was losing its footing, and it gets you out. So we can use breakouts to help us know when to get in, and when they fail, we know there's a situation which we've got to be really manage our risk around. So I like those breakouts, Rog. I think they're a valuable tool everyone should have in their trading pocket.
Yes, a good explanation on both sides there, actually. When it's going to keep on going, when it's going to fail. All right. So I know you like buying the break, but everyone has different strategies, Jason. I prefer waiting for the dip and getting some confirmation again to the upside. Can you explain that sort of strategy?
Yeah. So breaks can lead to quick moves to the upside, and that's what happens when a market quickly moves to the upside. It can become overstretched, and when it's overstretched, then it often pulls back towards those moving averages. It's something we talk about quite a bit, and that can provide another buying opportunity. So not everything has to be done buying into strength. If you're buying the right type of pullback, there's certainly a case for that. So we'll have a look at I'll get some more examples going, and because it's always good to see things on a chart, I think. So I often talk about when a stock runs hard, it often doesn't loses some of those asymmetric properties where we where we can manage risk around. So this is where buying the pullback can be helpful. So this is a stock from my portfolio. Bravia Solutions, BVS is the stock code. And so these pullbacks can sometimes give us a better entry point. So I got a signal to buy this stock on just after these two big up days. So let me just move this across a bit. So a couple of quick up days, and I got a signal to buy. And I watched it the next morning. It opened, started pulling back, so I didn't buy it straight away because I think, well, sometimes if you're getting some weakness coming into a stock, sometimes it's okay just to step back and just see how it plays out. And also thinking about the So I just thought, look, I'll just give this a bit of time, see how it plays out. And we start, because often we get those pullbacks, as you're talking about, Rog, pull back to the moving averages, and that's what we started to see. We started to see this pullback to the averages. So I haven't bought the breakout as I often would, because we've got that initial weakness coming in. But I'm watching the price action because it does look like a positive setup, in that we've got a stock which has gone from below moving averages to above averages. Moving averages have crossed. We've had an initial pullback to the averages and a rally. So overall, I like this structure. It's just timing the entry point. So I'm watching this price action. You can see we get this bit of a move upwards a few days later on the 15th. So my entry signal was on the 6th, and now it's the 15th. I bought on this day here. I bought in at around 82 cents because I thought, look, we've had a bit of a pullback. Maybe we're starting to rally again. Turns out I was a week or two early because it did continue to pull back again. Came back to the averages. But that's okay. You don't have to pinpoint the entry. It was still a better entry than I had I just bought the high on the day. I've got a bit of a pullback. I bought the dip above rising moving averages, and my exit point is nicely below there, so I can see off a bit of sideways consolidation, and then we do start to get that rally off the averages, and the trade progresses, and it's doing quite nicely. It's actually don't know what it's up. So from where I got in, where are we? It's currently it's coming about 80%. So up about 80% from buying the dip. But need to stress it's buying a dip above rising moving averages. I think that's a really important point to make. Just on that, I'll make this point with this previous stock we're looking at, TUA, because I was talking about these ranges, how the market was coming back to rising moving averages. So you can these are dips you can potentially buy. Buying dips back towards rising moving averages. Just come across a little bit. This is going back a little bit further in time. We've got a dip, but this dip is below moving averages, which are starting to roll over. So it's a different type of situation. Buying dips towards rising moving averages, sure. But I don't want to buy a dip that falls below moving averages when the moving averages start to roll over, because it changes the structure. It's a different structure now, and it's a vulnerable structure which can, not always, but can lead to declines, which would have been the case there. So it's not just buy any old dip, buy the right type of dip. So coming back to our stock here. So buying these dips has proved to be been a good strategy. I think there's one of the risks with waiting for a dip though. So I think this can work out well. It sometimes helps to be able to be flexible with buying. As I was flexible in this case, it wasn't. So I didn't buy the break as such. I bought the dip, so I was flexible with my approach. I didn't move from my default position of buying the break. With buying the dip, one of the risks with buying the dip is that the dip doesn't come sometime soon, or it doesn't come anytime soon. I'll show you what I mean. So I just use the S&P 500. So and this is just recently, we went from below the averages to above, and I got caught on this myself because I was looking at this and I was thinking we got above. I said, look, I think this is a bullish chart structure. And I said words to this effect. I said, if this was a stock chart, this is a stock I'd want to be long because we have a false break to the downside. We've got a quick rally back. It looks like it wants to go higher. I thought it was going to chop around for a few weeks and consolidate that initial gain, pull back to the moving averages, create a buy the dip opportunity perhaps, and then start to rally. Didn't do that. So if you've been waiting for a pullback to the 50-day moving average, you're not in this market. So fortunately, I've been long through my ASX portfolio, so it's been okay. But this is what happens when sometimes if you're waiting to buy the dip just doesn't come. I'll give you another example. This is an ASX stock. Stock called Superloop. So it's a takeover situation now. It's an internet provider. So I got a signal for this right here on the 20th of February. Actually, it was the day before. It was on the 19th of February. Got a buy signal. And the next day it opens, comes back. It's in the red. So it's the same as I did with BVS. I just said, the market, the ASX 200 was at its highs. It looked like maybe it was going to pause. have a little bit of a pullback. And I thought, look, if that happens, maybe it's going to pull back towards its average as well. So I can just watch this for a day or two, see what happens. I'm watching, and then I look at it and it's gapped higher. And so there's something going on. I didn't know what was going on, but the price action was positive. So I didn't say, look, I'm now going to wait for it to pull back, because I was concerned that this was it was lifting off a basing pattern and it could accelerate to the upside. So I bought it at like 82 cents. I was meant to buy a few days earlier at 73, but for those reasons I said, I was seeing whether it was going to pull back a bit during maybe with the market consolidation, but it didn't. So when I saw it was up, I just pulled the trigger and bought it. So I bought into strength. Had I waited for the dip, well, I wouldn't be in. And this has been a nice trade. It's been a quick trade, and it's been good. So waiting for the dip would have been costly. So I like buying the right type of dip, absolutely. But I also want to be mindful that I don't want to miss situations like Superloop, which can get away from you if you're too rigid on saying, look, I won't buy until it pulls back. So flexibility is so important in these markets. We've got our rules which we follow, but then also being able to just be aware of the price action, what's happening around you, and if you're trying to get something a little bit cheaper, sometimes you do need to just quickly act. Otherwise, you can miss out.
Yeah, I agree, Jason. I think I've missed out on quite a few of those opportunities, and I think it's one of those things when you have that as part of your trading plan, you've got to acknowledge that you're going to miss out on those opportunities, and that there's plenty more, which you've always told me, right? So it probably keeps me out of every single opportunity that comes across, because there's so many of them, right? And then I sort of wait to see if it does bounce off those moving averages, or if it goes underneath the moving averages. If it goes underneath the moving averages, it's off my list, right? So it gets cut off my list. So that's the way I do it. Everyone has to have a different system, once again, based on their rules, their strategies, their timings, and everything along those lines. But there are some great examples that you've shown there, Jason. So that's really, really good.
It's always one thing, Roger. It's also important to remember that every system won't get every stock. It's like, we can't get everything. We don't have enough capital to get everything anyway. So,
exactly.
If you miss a few, well, you don't want to miss a few because you didn't follow your rules. I've missed a few because of that, because I've been cautious, and I thought, maybe I don't want to buy here because I think the market's a bit edgy, and then the thing runs, and it's really frustrating when you miss a stock because you don't follow your rules. Fortunately, it doesn't happen too often, but it does happen. But every process is, you just won't get everything. Like, part of my motion trader setup is I use a volatility filter which filters out stocks which have become excessively volatile. And when I do the back test, like, sometimes I think, oh, look, I missed this great stock because I had this volatility filter there. I should take it off. So I do the back test without the volatility, and each and every time it reminds me why I have it there, because it removes many more situations that I don't want to see than good ones that I miss. So I keep the volatility filter in there. On balance, it provides a positive result, but not it will miss some situations, and that's just how it's going to be. We won't get everything, and we don't need to. If you can get into some good setups, you can let your profits run. You're almost certainly going to get some great stocks over time that go up 100%, 200% or more. And then you're going to get plenty more that don't do anything exciting at all, but you cut them. You've got a strategy for getting out of them. Keep your good ones, get rid of the duds, plenty in between, and that's how you can outperform.
Yeah. And I think my solution is to see those ones that run without the pullback is just to delete them completely from my view, so I never see the upside potential that I could have had from them, right? So just to never look at it again, right? So, but thanks for reminding me of that Superloop one.
And that is a good thing to do, that you don't constantly go back to look at it. It's like, people can get mental scars from these things because they're constantly going back and thinking about what could have been, and it's a very human thing to do. but it's best not to dwell on stuff. And people can get it, a stock which is someone's lost money on, they form a grudge against it, and all sorts of mental things can happen there. Either they've got to make their money back up on that particular stock that's cost them money, and that leads to its own troubles because you're trying to force trades which aren't there, or you're doubling up and you're doing destructive behaviours like that. Or it might be a stock where you've lost money on 3 times, it's broken out 3 times, 3 times it's failed, and you go, oh, this is a lousy stock, it always costs me money, and you go, nope, I'm ignoring the break this time, and that's the one where it runs on. Mm-hmm. So it's markets make it difficult. If it was simple, if it was easy, well, we know how it goes. Everyone does really well, but it's not designed that way. It's all these emotions from all these people coming in, and things whip around, and it's unless you got a good process, really, I think you got no chance without a process, unless you buy and hold and an index ETF for 30 years or something. You probably do well then. But if you're just buying stocks without that process, I think it's just trouble.
Yeah, good point. All right, let's get on to some tickers here. Let's start off with CKF. What does that look like?
Okay, so let's jump back to our charts. Okay, so Collins Food, that owns KFC and various fast food operations. And so this is like that situation we looked at in TUA, where I would just jump back a little while ago. Like it looks like, here it is here. It looks a bit like this situation here. Where's it gone? So we've gone from above the averages to below. The averages have rolled over. They're close to crossing. We're getting this tight consolidation beneath the averages. So this is a warning flag. Doesn't mean it has to go down. It could still revive and go up from here. But I think this is a stock with elevated risk. And the risk is that it gets a sharp break to the downside. Much of the bad stuff happens below the moving averages. So it's in that vulnerable position where whatever it is could happen, that it does sharply move down. So if I was in this, I'd want to know where my exit point was and be ready to move out. If I was in and I had good profits in it and it was still above my trailing stop, well, I'd sit with it. I'll show you an example I remember, which is just like this. It's in Calix. This was from a while ago, so I'm certainly not in it at the moment. So we've got to go back a few years. Similar situation in that Calix had a great run. It had this fall. It was below the moving averages. The moving averages hadn't crossed yet, but they were getting close, and it was consolidating below the averages. And I remember this time because I had here's my entry point way down here. It was up a few 100%. Might have been up 400% or something. So I had a big profit in it, and I was watching it carefully, and it was like, well, is this? I thought it was going to break to the downside because it had all the looks of the stock which was going to break to the downside, but it didn't. It had one more run, then it came back, and I got out. So again, it looks like that's what we look like when we look at what was it? Rog, what's that stock code again?
CKF. Sorry, KFC, just the other way around. Okay.
Yeah, that's what I went for. So we've got we've got that same structure building now. So it could still recover. So you could still give it I could still give it the benefit of the doubt, but I'm ready. I'm ready because it's vulnerable. It's in a vulnerable position.
Mm-hmm. All right. What about VUL, Vulcan Energy?
Yeah, well, that's interesting. We've gone from below the averages to above. So this has come out of a big period of just, stay away from. There's nothing good happening here when it's declining below these moving averages. And you see all these little breakouts, but they're to the downside. You see the tight compression brands, which I like so much when we come back to rising moving averages. But you've got the reverse situation in a declining market. We've got the tight consolidation to the moving averages, but they're to the downside. And now the most likely outcome is a break to the downside, which happens, and that this continues all the way down. But now we've gone from below to above. The averages are crossing. I think this is a really interesting stock. It's early-ish, but for someone wanting to be a bit more aggressive, this is a potential buy the dip moment, because we're pulling back to rising moving averages. You think, like, how could you manage the risk around this? And looking at current levels, it's like it probably takes I think this probably requires about a 25% stop loss on it to buy the dip. It's preemptive, but you look at the upside potential and you go, well, look, if this stock, like, where's it come from? It's come from a long way up. Even if it just got back to where it was, this time last year, you're looking at like 150% or something like that. So 25% of risk, 150% possible upside is asymmetric. The structure's turning positive. So it's a stock with potential. The other strategy is just to wait and see if it tracks sideways for a while, builds a bit of a base, and then starts to break out. Then maybe it's a case of buying the breakout with the positive moving averages. And so different ways to play it. But for someone who likes to buy the dip, wants to take on an extra risk, be preemptive, that's a possibility. And
I like that. It's good breakout of a previous lower high as well. So it's
I've just got a stock here because a member emailed me a stock beforehand. So just so I don't forget, I'll just have a quick look at this before we jump back to yours, Raj. And it's this one here, AEI, Aeris Environmental. And it's not dissimilar to the stock we just looked at, in that it's fallen from great heights, so lots of time to avoid it and not be interested, not even be looking at it. But moving averages have only recently crossed. We're above those averages, and now we're going on a bit of a run. It's a low price stock. It's only 6.5 cents. So this one won't turn up in the motion trader signals because of just the way the percentages work. It's too volatile. So it's doubled in the last few weeks. It's come from 3 cents to 6 cents. But it'll fail the motion trader volatility filter, but it meets the criteria in terms of breaking to a 70-day high, being above rising moving averages. So it would have met all the criteria bar the volatility filter on the early February. So for someone who was interested in this, look, if someone's in this stock, I'd stay in it. If I was in it, I'd stay in this at this point and see where this goes, because some of these things, it's like cocoa. Some of these things can go an extraordinary way. Most won't, but some can. So if I'm in the game, I want to stay in this game and see how it goes. In terms of if I was looking to establish a position, I think that's a bit harder in terms of where's my risk point? I'd probably look at this recent low and this previous high and say, look, there's probably some support across there at around 5 cents. And if this is really going to take off, I probably don't want to see this current point come back and overlap with this previous high and low and this previous high. A bullish structure would just pull back slightly, consolidate, and then continue on. So one exit point would be just back near the 50-day moving average. That's about 28%. So getting close to 30%. So there's a bit of risk on board, but you look at your upside potential. It's very much asymmetric. So it's looking at these stocks at the right time. Trying to buy it during the downtrend, forget about that. That's all way too hard. But now we've got some signs of upward momentum. There's buying interest coming in it for whatever reason. Yeah, it's a target with potential.
Very good. It just looks so obvious when you're looking at charts like that. Up and down. That's it. Down and up. It's buying out.
But then you get the ones like this that it'll get to there and then it will just chug sideways and do nothing for 5 years, just chopping back and forth, being a pain. And not suggesting this stock's going to do it, but I've seen this many times where it's fallen from great heights. And what goes down doesn't necessarily have to go up again, like in a cycle. It sometimes what comes down stays down, and it just goes sideways for years within between, say, using this for example, between 2 and 10 cents. It's if you want to try and get it at 2 and sell it at 10, well, you can make some money, but it's really hard, much harder than it seems when you look back in hindsight.
Yeah, of course, we've got to think that even though we just analyze it technically, these companies, there's been a reason why there's been a pop, but that doesn't mean that there's been a fundamental reason for that to happen. It doesn't mean that fundamental reason is going to continue to allow that company to grow. I've seen it so many times where it's come, like you said, fallen from grace, has a little bit of a pop, but then just goes sideways because nothing else is happening in that company fundamentally, right? So that no one else is investing in it, right? So it's just stuck there.
And this is a great thing about momentum, because momentum puts a spotlight on stocks like this. So for those who like their fundamentals, they can then go, right, now I can go and really pull this stock apart from the balance sheet perspective. What are they doing? Is there a story here? Are the directors buying? What's going on? And they look for all the fundamental pieces to support the price action. If they don't find it, well, then they go, okay, well, I'll just leave it alone. But if they find it, well, then that can really give them a degree of confidence about going in. My own way, well, I'm not digging into the balance sheet. I'm just going with the momentum and managing the risk. But as we spoke about earlier, there's many different ways of doing this. I don't think there's any best way. It's just finding the best way that you're able to apply, which works, and that'll vary for everyone.
Exactly. All right, so let's look at OOO, the ETF for oil.
Yes. I've been talking about oil on my weekly strategy sessions, and I've had a bullish bias on this probably for the last 4 or 5 weeks. It's slowly been edging its way higher. And look, the moving averages have crossed, broken to a new high. I think there's some upside potential in oil. If I'm in this, I'm holding this at the moment. It could consolidate back, let these moving averages catch up. It's difficult when you look at an oil ETF in Aussie dollars, because the main price mover is going to be the US dollar contract, which is, when you look at the US one, it's just heading up into resistance at the moment. So maybe it is a case where it could consolidate sideways, let these moving averages come up. So this is the one I'd probably be using to base my decisions off what's happening in this. This is a CFD on crude oil, but it's tracking the futures price, which is the main game really for oil. But yeah, I like this series of rising lows and rising highs. Not dissimilar to that price action we spoke about earlier in the Chinese and Hong Kong markets. This ETF looks interesting.
Very good. What about CSL? And we'll do the last 2, and that's it, I think.
CSL. Okay, well, this is a buy the dip moment. It's pull back to those averages. It's not a confidence boosting pullback, because it's a sharp pullback and the moving averages are starting to bend. So I'd still have an upward bias to this, because the overall, we've really been moving sideways for quite a while now, for 4 years or so. We've just been tracking sideways. You can get a bit of a range from this, and a bit of a false break to the downside in October. That's when the ASX 200 gave us that false break to the downside and has come back up. So if I had this in the portfolio, well, I'd keep it for now. There's no reason to really move it on. But for me, it's not a compelling buy at this point. But it for me, it would probably also, if I had it, it'd be worth holding, because maybe that's it. That's an initial move. It's consolidating, and it does start to move back towards the upper end of this big band that's been in for 4 years. But not a stock I've really got a strong viewpoint on.
All right, Duratec.
Well, this was part of my portfolio until last week, and this has been a great trend. Here's my buying point when the moving averages first cross, and this is a motion trader stock, and we had a motion trader exit last week when the price came back to what was it, 108 or 108 and a half was the exit point. Had a rebound. I sold into the rebound. So I think I've been talking about this last week. I sold half my position on the close on the day of the stop. So the stop was here. I saw the price start to rebound. So I just thought, okay, let's see where it goes. Watched it through the day, got up to the highs. I sold it there, and then sold the other half on the open the next day. It's really just saying, look, it's become a bit stretched from these moving averages. So there's a good chance we'll have some sort of a rebound, and then maybe continue lower. It has continued lower, having a bit of a bounce today. But look, if it's certainly not a buy for me, because these moving averages have crossed to the downside, and it's making new lows. So it's not a dip I want to buy. I want to buy the dip when the price is rising above the moving averages. The structure has fundamentally changed now. We've gone from above average moving averages to below moving averages. So this isn't the point where I want to be buying. If I'm in it, if anything, I'm looking for, look, do I get a bit more of a bounce to sell? I'll be looking to exit my position as I have. Now, there's nothing saying that this can't be the final low and the stock does make its way up to new highs. It's entirely possible, and that will happen. And it's happened to me on occasion where I've sold a stock and then watched it go off to new highs. It's like, well, it's a bit frustrating, but that's just the way. It's like there's going to be some stocks that just tap your trailing stop, get you out and go back up, and others tap the trailing stop and then continue to decline for months on end. We only know which ones they are in hindsight. So we can't trade in hindsight. We can't invest in hindsight. We've got to deal with what we have at the moment. So I think the balance of risk with Duratec has shifted to the downside. So yeah, that'd be my position. Well, that's what I've done. So I'm talking with my actions. I was in, now I'm out with a really good profit, because I let this profit run for a year or so. And for me, it's now the time to, let Duratec take a bow and leave the stage, move on to the next opportunity.
Okay, and the last one, BRG, please, Jason.
Breville. Well, look, there's this. Well, this is buy the dip opportunity. If you want to buy a dip, it's got a rising trend. It's come back to the moving averages. It's on the 100-day, and looks to be getting a rebound on that. It's a stock which has been a really good stock for a number of years. Breville, quite a big pullback during 2022. I think it was like 40% or something. Let me just have a quick look. 50%. So 50% pullback, and now it's been making its way higher, like higher lows, series of higher lows, back to those moving averages. It's got the potential to base here and continue its upward path. So if one were to buy the dip, the exit point would probably be, look, it could be below this low point from February. So let's just do some measurements. So it could be like potentially a 14% stop loss, or more aggressively just below the most recent low. Like maybe it could be bought with a 5% stop loss. And you go, well, what's the upside potential? Well, it's certainly back to the previous highs and potentially beyond. So there's 30% or more of upside potential. So upside potential is open. So yeah, it's one of those stocks which does have those asymmetric properties, and yeah, there's an opportunity there.
Okay, fantastic. Thank you, Jason, very much for those. Just final reminder, please like and subscribe and write any comments you have. Send any questions you have in, so we'll be prepared for next week beforehand as well. If you want to check out some of the stuff that Jason does, especially, I think you've opened up a can of worms today, Jason, with your volatility index. You can go to his website, motiontrader.com.au, and you can get a whole bunch of free stuff all around his strategies. In fact, he lays it all out for you for free, I think. So go over there and check that out. All right. Once again, Selfwealth is not Motion Trader. You need to go to Jason to find out. But Jason executes on Selfwealth, and that's where you can come over to Selfwealth if you're not already a user, and you can trade for a fixed price of $9.50. So there's none of that percentage base brokerage that a lot of the banks charge, right? So obviously anything we've spoken about today, please take it. Do your own research, do your own due diligence. Past performance doesn't necessarily equal future performance. All that sort of stuff that you'll hear from the financial professionals all the time. It all applies. So please take care out there in the markets. Appreciate everything, Jason. I appreciate everyone else here. And now Baz is off for a run, and I'd love to be off for a run. Are you off for a run, Jason, now, or?
Yeah, I'll be off pretty soon for the daily running.
And we better let you go then. There's links always down in the to everything that we talk about in the description on this video as well. All right, guys. Thanks, and we'll see you next week. Thanks, guys. Bye-bye.
Thanks, everyone.